Hey folks, it's Dave Burrows. It is Tuesday, 4 p.m. time for Barometer Readings webcast. I want to thank everybody for jumping on today. Lots going on in the market, lots of things to think about. We are in a news-driven market. Some of the things that are going on have been going on now for 7-8 months. Some of the weakness in technology, probably less related to tariffs. Some of the economically sensitive groups have been under pressure with concern as to what tariffs might ultimately do, not just in the way they slow down spending, but in the way that they shake people's confidence and make it difficult for businesses to make decisions. Obviously, the situation is fluid. And so, as always, what we like to do is go through the charts, take a look at what we're seeing in the shorter term and a longer term picture to make sure that the things that we're doing in the portfolios make sense, given what we know and given sort of the signaling we're getting from markets. So just to start, as we always do from a top down, this is an updated long-term chart of the Dow Jones Industrial Average back to 1897. And we've always talked about the fact when markets go through a long period of time without making progress and then ultimately start making a new high or getting above this 200-week moving average and staying above, that's a structural bull market. And so when that happens, two things generally are happening. First of all, earnings are growing. Generally, after a long period of time of market underperformance, stock market winds up underowned and unloved and not trusted. And so you not only get earnings growth, but you start to get multiple expansion where investors, as they get more confident that things are getting better, are prepared to pay a higher multiple of earnings as time goes by, because it looks like it'll go on forever. So from 1950 to 1966, market was up 474% over 16 years. And eventually, in that case, inflation really started getting sticky and the market ran out of gas and money started going other places. Started going into income-oriented investments where people saw more certainty. And every time the market had one of these wobbles back and forth across the 200-week moving average, people lost confidence. Now, eventually, of course, at some point, market gains a bunch of power. Companies build on their earnings and their cash flows. The situation changes. In this case, we got to Ronald Reagan's election and he started to deregulate. And at the moment that people thought stocks were dead for good, we rallied 18 years and the market rallied 1,200% over that period. And in there, along the way, we had the 1987 crash. We had the 1990-91 recession, which looks like a bit of a blip on the chart here. But again, you stayed above that rising 200-week moving average all the way along until ultimately in 2000, technology rolled over first. And old economy stocks actually did quite well for the first 18 months, but then ultimately, things got difficult there as well. So you had the tech wreck and you had the financial crisis, 2007 through 9. So the S&P and the Dow have been making higher highs and higher lows since 2012, beginning of 2013. Market's up about 305% as of today. So a long way from 1,200%. And a long way from 500%, 475%. But, this has been going on 12 years. We remain above this long-term moving average. So as far as we can see, we continue to be in a structural bull market. But there are some things that cause us some concern. And at the end of the day, money goes to the place where it's treated the best. Now, there were places to make money between 2000 and 2013, even though the U.S. stock market didn't go anywhere. Commodity prices did really well. There was money to be made there. So the Canadian stock market did quite well, energy and materials. Global stocks did quite well. And the US dollar faltered and the market faltered and money slowly rotated. So I raised that as a possibility because we are seeing changes take place in this market. Now in the near term, the S&P has continued to be above this long-term moving average. The S&P is down 5.6% as of about 3:30 this afternoon in the month of April. It's a third month in a row down. It's been a tricky market. We rolled over. We broke the 50-day moving average in blue. came down, broke the 200-day moving average. We rallied up underneath it. Market failed as the tariffs news started to really kick in. We sold off down to long-term support. About 10 days ago, market had a big reversal day and rallied up underneath the point it broke down from. But as is often the case, and we talked about this last week, markets rarely V-bottom unless it's some technical factor that's driving things. I think in the circumstances we're in today, market sold off on the uncertainty of tariffs and what that might mean for businesses. We do not have any certainty. We have no clarity. And here we are now heading into earnings season. So we're in the beginning. So a couple things that means. First of all, it means that companies are not buying their own shares. Share buybacks are halted going into earnings. They're in a blackout period until they report, and then they have the same information as everybody else. They can go do whatever they want. Market did have a big up day, and we have come back, and we haven't got back to the lows. I think it's positive so far. We have not done that. But the truth is, probably the market has a little bit of work to do, given the amount of uncertainty that we have. So we talk about how often you like to see a really big day. And on April the 9th, we had a 34-1 up day versus down day. This is the day that supposedly there was a flipping happening on the tariffs. And of course, the market rallied for a couple of days. We said last week, we need to see a follow-through day. That's a second day where the market's up sort of 2% or more on twice the average daily traded volume. And as of now, that has not happened as of today. What did happen was that in the week where the market had that big bump, we had record buying of leveraged long ETFs. That's largely private investors saying, here's my chance to buy the dip. And not only did they buy the dip, but they bought ETFs that were double or triple weighted, levered to the market. That's not generally what happens at an important low in the market. It's very rare that when the market's making a low, everybody decides on the same day, today is the day, this is my lucky day, I'm going to get really invested here at the bottom. What we need to see is a lot of stocks making advances as a percent of the total over a 10-day average, and we're just not seeing that yet. Doesn't mean that we can't get there, but it hasn't happening yet. When we look at the percent of stocks making a 20-day high, so as we go through these processes, the market does some sorting. The companies that are most impacted by whatever it is that's bothering the market generally continue to be weak, but some of the stocks that may be better suited to the environment start to outperform. And so we talked last week about building our farm team, looking for companies that hold up better than the rest, or on a strong day bounce a lot more than the rest. And what I can say is internally, the percent of stocks making 20-day new highs is pretty low. So no major sign there that we're seeing that. If you go back, as the market was bottoming in the fall of 2022, tons of days and weeks where a majority of stocks were making 20-day new highs. That's the sign of a reversal in the market. When we look through the first 74 days of the year, 2025 stacks up in the range of dates from 1928 to 2025, down 12.3% as of this morning. Or maybe it was yesterday. It was down 15% for the S&P as of yesterday. NASDAQ just around 20. And when you look at what happened from day 75 to the end of the year, it's a mixed picture. So when I look at this data, we don't make decisions based on it, but I love to see that we've got the backing of the market. Now, more days up than down, but some pretty bad up years, but some pretty bad down years. So not enough to help us to make a decision. Full calendar year return tends to be sort of mixed. So needless to say, some of these actions, whether or not in the long term they wind up being good for the US economy, they're not very good for the stock market in the near term. It raises a lot of questions, a lot of uncertainty. And, we have to deal with the market that we're given. I think things were trucking along pretty well leading into these tariffs, but certainly there was rotation taking place. And I think that, it was about where are you positioned. When we look at the NASDAQ, you can see what a big volume sell-off it was. And now we've got, the moving averages, the 200-day moving averages rolled over, the 50-day moving average has come down through the 200-day moving average. Technically, not generally a great sign. They call it a death cross. I don't put too much stock in that. But, same thing. We bounced up to the point where we broke down and sort of failed. So we'll see. Market certainly got sold out in the near term. We'll see whether that turns into something more. The one thing I would say is if there is enough uncertainty that's been created or enough roadblocks for the economy that we wind up with a recession, 15% doesn't discount a recession. So I think there are people that think that there could be a 50 to 60% chance of a recession. If that's the case, market probably winds up, down 25% at some point. It may well be something happens to avert it and we stay open-minded to that. But we also are probably, need to be pretty cautious. So as I mentioned, lots of buying and leveraged ETFs, and don't love that. When we look at valuations and what's happened in the concentration in the market, the weight of the 10 biggest stocks in the market, got as high as 38%. And we know that the number got very high in 2000 before the technology stocks rolled over. We know a number got very high and concentrated in 1973 before the market rolled over, 1964 before the market rolled over in 1965. So, we pay attention to these things and we pay attention to the earnings revisions. When we look at the earnings for 2025, first quarter, second quarter, third quarter, and fourth quarter, when we look at where the estimates are today in aggregate earnings for the S&P versus where they were in October, they are being revised lower. So two things. One, we're going to watch what the earnings are going through this period. Some companies have much more predictable earnings than others. More importantly, we're probably going to need to listen to the commentary that we get from companies. And it's going to be very hard, I think, for companies to be very clear about what they expect for earnings for the rest of the year. So again, one of those things that raises some uncertainty. When we look at the amount of revisions to the downside in earnings, they're significant. So we don't want to ignore that. Now, today, at one point, the market rallied, and I guess Scott Bessent said that he was hopeful that they'd be able to come to a deal with China and things would get more constructive. One of our analysts, Amit, brought this up this morning. They looked at the length of time generally it took to come to a deal on trade and then to actually implement the deal. And so it took on average over time, all of these different deals, 18 months to get to a deal and 45 months to implement. So I think it's unreasonable to think that these deals are all going to get done in the first month or two. Certainly the administration is backing itself into a bit of a corner. So look, we don't have to be everywhere. We only need to have a few core ideas to take advantage of in a market. Leadership can be broad, it can be narrow, and it can change. So our job with the tools that we have is to find the leadership. What is it that has a tailwind? And that could be any asset class, could be bonds, could be stocks, could be commodities. It could be different geographic regions like the US versus the rest of the world. It could be certain industry groups. We're always watching for change, and we spend time talking about that in this webcast every week. And there's times when there's a lack of leadership when it's time to play defense. So what we are trying to provide to our clients is a tactical approach, right? A rules-based, reality-based approach to trying to make sure the portfolios make sense given the environment that we're in. And, really simply, we've always felt when breadth starts to deteriorate in a sector or a theme, it may be our securities sail through just fine, but it does mean that the floor is getting thinner under our feet. And that causes us to be more defensive, to stop putting on new positions, right? To have some cash in the portfolios. We may be looking for things that we might like to do if conditions improve, building the farm team, but we hold off on putting on new positions. So we're in an interesting market. I mentioned we would likely see indicators turn higher at some point, and then maybe we would see a retest where they would get weaker again before they put in a higher low. We are seeing some improvement in the short-term indicators. Percent of stocks trading above the 50-day moving average really around the world is better. Percent of stocks with positive weekly momentum, that's upward trajectory. percent of stocks making new highs versus new lows, coming off a very low number, and the percent of stocks trading above their 150-day moving average. So the market is sorting. There are stocks trading above their moving averages. Not so many, but there are some. And the question is, will we get a retest? When I look at, another way of looking at this, the percentage of stocks trading above their 200-day moving average, you can see that we did get down to 15% and have bounced. But I want to keep in mind, for instance, 22, you bounced and retested. In other words, you get a second bout of weakness. Same thing happened in 2015-16. And these were more economic concerns. This was a slowdown in China. 2011-12, same thing. You had some testing. When we look at what happened in 2022, well, as soon as it was possible that we could see a Fed rate cut, things sort of bottomed. My guess is we have enough uncertainty right now. Maybe there's a process to go through. But when we look around the world, there are some things that stand out. The first thing is that most of the regions around the world have shown significant improvement, and in fact did not get nearly as bad as things were in the US. So if I put all countries on a distribution curve and plug in the geographic regions based on the percent of stocks and uptrends, you can see like London has over 50% of stocks and uptrends. Europe pushing on 50%, Japan pushing on 50%. And we've talked about this. While US stocks are relatively expensive, we're seeing much better performance outside. So these are monthly bars. So if I, for instance, look at what's happened in Japan over the last month, had a big dip down to the moving average and has recovered 2/3 of what was given up over the course of the month. If we look at Europe, the Euro Stoxx 50, now look at this move down, and we've recovered basically to where we were at the beginning of the month, while the S&P is still down 5.5%, 6%, with the Nasdaq's down 8%. Germany's actually now up on the month. And similarly to what we were talking about last week, these markets have all come out of long periods of not making progress. So just like that first slide we talked about today, when you came out of those periods where the market went nowhere for a long period of time and finally started making highs, that's generally the beginning of a new bull market. So while I think that we are still in a structural bull market in North America or the US, it has historically been the case that when global stocks start to outperform, US stocks go to sleep. Money rotates from one place to another. It's possible that after many years where global stocks did poorly and the currencies did poorly, now that their currencies are getting better and their stock markets are outperforming, that global investors start to take money home to their home markets. That's France, that's Spain making new highs, actually. The last 3 months, we are higher in Spain. Italy, same picture. India came out of a bear market back in 2020 and has had a couple of corrections along the way, but is probably 4 years into a new bull market. Argentina, not too dissimilar. So one of the things we like to see is when the market really goes into a sell-off, how does the leadership do? And we've talked over the last year about how global stocks are a lot less expensive than US stocks. The sector makeups of these markets are in sectors that have been doing quite well over the last year, in particular financials, but also energy and materials. And there's the TSX. TSX, again, has recaptured most of what's been given up over the course of the month. So this is quite interesting. Of course, all of these countries are the countries that have had tariffs levied against them, yet they're outperforming. As of last week, now I think this is as of the 18th of April, US stock market down 10%, and the rest of the world acting better. So it's our job kind of to rotate. We started a year ago with this global equity fund, all world ex-US, and it's been great. That's 10% of most client accounts. Over the last couple of weeks, where we have put money to work has been in global markets, not in the US market. In the US and the global markets, the US market is underperforming the rest of the world by the most since 1988. And when it starts, it generally goes on for some time. So we think that that's relevant. Another contributing factor, I think, is the US dollar. And the US dollar, this is the DXY, which is a basket, the US dollar versus a basket of currencies. So versus the euro, the yen, the British pound, the Canadian dollar. And frankly, all currencies are now rallying versus the dollar. So we talked about this a few weeks ago when the tariffs got announced. The Canadian dollar was unable to make a lower low than it did back in the COVID sell-off or the 2015-16 slowdown in Asia, which had an impact on us as a materials producer. And frankly, you know, we've now seen the Canadian dollar rally from 68 to 72.5. And in this process, you know, we have been hedged in our pools and funds back to Canadian dollars just because we think Canadian dollar can continue to firm. Japanese yen, you know, this is going back over the last couple of years. Yen was very weak and clearly moving higher versus the dollar. The euro has broken a trend going back to 2011. So if the currency is going down and there have been massive flows into US ETFs by global investors, it's safe to say maybe some money can rotate away. Last year was a massive year for global buying of US stocks. They talked about US exceptionalism, that there was no Nvidia or there was no Google, or there was no Apple in global markets. Now, of course, they've been underperforming since June of last year. So if the US stock market's lagging and the currency is lagging and the bond market is lagging, it's safe to say that it takes time, but pension committees and institutional investors are probably thinking maybe we take some of this money home because our markets are performing better. As of last week, the number of investors considering underweighting or wanting to be underweight US stocks has really started to lift. So something to keep in mind. So TSX relative to the equal weight S&P since 2009, we're seeing a clear reversal here. Makes us more bullish on Canada. We'll see what happens in the election. And MSCI All World ex-US index versus the equally weighted S&P. This is the last 5 months, steady outperformance. So I do think that this is probably the beginning of something, and it could go on a while. In 2001, the US dollar started to underperform and went down 40% over the next 8-9 years, as gold did quite a lot better. So on fixed income, same picture. Long-term US bond yields actually continue to go higher. This has been perplexing for the US administration. I think they hoped if they could mute the stock market and give people questions about the economy, bond yields would come down and give them an opportunity to refinance all of the bonds that have to be refinanced this year, $7 trillion worth of bonds. Instead, I think global investors have said, you know what, maybe we'll do something else with our money. So the long end of the US bond market, you know, prices have been falling since 2020 and they just sort of continue to fall. So really we've sort of stayed away from the US bond market. And global investors, I think, are doing the same thing. This is the Japanese resident net investment in foreign bonds. You know, things are going better in Japan, so they're reducing their investments in foreign bonds. So our global equity fund, I'm pretty happy with since inception. It's up 23%, well ahead of the MSCI All World ex-US index. We have had some cash in the portfolio, which we deployed over the course of this week. Because global stocks have resumed, you know, acting a lot better. On commodities, commodities had a sharp move down when the tariffs were announced, but they really bounced. And so very clearly, we said last week, we think that we're, you know, remain in an uptrend. We're above all these moving averages. Moving averages are moving higher. And, you know, really, we're seeing that take place. Gold, which was off a little bit today, you know, is clearly, again, in an uptrend. It's about 60% above the 200-week moving average, you know, which is getting there. It really has been outperforming stocks and bonds. It's been a great add in the portfolios. Could it correct at any time? Of course it could. I was looking at this, you know, we have to remember that a lot of the purchases have been central banks and not private investors. So the driver over the last couple of years, as gold has been behaving well, has largely been central banks buying. And when we look at sort of the last couple of years and break it out this way, this is central bank holdings of gold, 2022, 23, 24. And since 2020 in general, investors have been reducing their exposure, even though it had a little bump here. So this is not over-owned by investors in general. I think we have a ton more gold than most do, and I understand that gold price was weak from 2012 through 2023, but it's certainly proving to be a valuable add in the portfolio. So just to put a point on it, we're about 60% above the long-term moving average in the bull market that happened after 2000. It got to close to 80% above the 200 week. So there's room. At some point, we will correct sort of sideways, and we'll see that at some point, and then we'll get another big move. But at this point, we continue to be pretty bullish. And this is the longer term structural chart that I've been showing, and I just want to keep it up. This is what makes me question what's happening in US stock markets, because the last time gold started to outperform the NASDAQ 100 was 2000. And of course, that was a big rollover in US tech stocks. And US tech stocks underperformed for the next 10 years. And so, this has been a pretty big shift that's taken place. And that does change this trend. So I do have some questions as to whether this sell-off in US tech might not be a longer term issue, which is why we will be, I think, pretty careful about re-adding exposure, even when the market gets a little better. I was showing on Twitter yesterday that if you looked at the chart of Cisco Systems, which was probably the highest quality tech stock in the US in 1999, it traded up to $80. And when tech stocks rolled over, the earnings slowed down. But what happened was people's confidence was shaken. And once earnings start to slow, they're willing to pay a lower multiple of earnings. Because over time, if it keeps beating estimates, keep beating estimates, investors get comfortable paying a bigger and bigger multiple, just like with NVIDIA. And when things did start to slow, not only did earnings go down, but the multiple compressed, and Cisco shares went from $80 to 17. So the difference from where a momentum investor stops buying, and clearly based on the triple leveraged ETFs that people were buying last week, they've not lost their appetite for the risk. If they do start giving up, they can go down a long way. So we want to be really careful there. And just like, gold can go up a long way. Silver continues to be very constructive. Copper, after a sharp sell-off when the tariffs were announced, has had 3 great weeks. And again, we've been in this range, going back to 2011. And so copper really seems to be shaping up. We'll see what happens with the stocks. I'm a little cautious because if there is risk of recession, copper is more economically sensitive. So, we watch with interest. Commodities look pretty good. Commodities relative to the equally weighted S&P continues to firm up. So commodities really outperforming stocks since 2022, some better, some worse. And certainly commodities relative to bonds strong. So this US dollar, I think, is something we want to watch. This is a longer term chart. This was where the US dollar rolled over in 2002 when tech stocks started to underperform. Money left because global stocks started to outperform. And, I never like to say things repeat, but they do rhyme, and we want to know what can happen. And this happened over many years, but from 2002 to 2008, US dollar went down 41%. So with global stocks outperforming and commodities outperforming, both of which did well through this period, we want to pay attention. Gold relative to QQQ looking quite interesting. Let's talk leadership just for a minute. Not tons of change here. Financials, if I look at the long-term chart, it's been in the bull market since 2020. We've had 2 months where they've come down. In both months, after selling off, they've bounced. I mean, frankly, financials are in the top 20% of the range from the last month. So they've bounced very nicely. We like to see, the leading sector outperform when there's a bounce. Relative strength has continued to rise. So this is the degree to which the sector is outperforming the market. So the financial sector is outperforming 73% of companies in the S&P. We're still below the 200-day moving average, so we're watching that, but it's certainly behaving better than many other groups. Insurance is the strongest group and continues to look well from a relative strength perspective. Companies like Fairfax, this is the biggest holding in the firm. And given the fact that you've had a 20% correction in the NASDAQ and 15-16% in the S&P, pretty darn happy the way this is hanging in. Obviously, not terribly economically sensitive, not subject to tariffs. I was surprised to come across this stat. We all hear about Berkshire Hathaway. Since 1985, these are the companies that have had the best returns in North America. And Fairfax ranks number 8 of all of the companies, US listed companies, at 19% a year. Turns out Progressive, which is another holding of ours, is in the list, and Enbridge is 15% a year over the period, and both have held up very, very well through this sell-off. So just something interesting to keep in mind. So the financials continue to do well. Intact Financial, which was a relatively newer ad over the last couple of months, is trading very close to new all-time highs. So financials continue to look good. When we look at European financials, they're just breaking out of a range going back to 2014. And boy, have they been resilient. Look at this sharp move down when the tariffs were announced, a sharp move right back up, very close to making new highs. So we did add Banco Santander, which is a global bank. It's a $100 billion company, trading better than 96% of companies in the S&P, very close to making new highs. And we're also looking at ICICI Bank in India, which is a $117 billion bank, and it's making new highs and really has seen a takeoff in relative strength. So these are the types of things that we look for when we go through these tough periods. What is it that's bucking the trend? What is it that's been able to hold up? And they go in our farm team. On energy did pull back to the moving average. It had nice 3 weeks of a bounce. Some better, some worse, but we're pretty pleased with the way ARC Resources is hanging in. In general, the natural gas producers are outperforming the market nicely and have been very resilient. We're actually, not only above the 200 and the 50-day, but the 21-day and the 8-day moving average. I think that's, pretty good. Expand Energy, similar, trading better than 90% of companies in the S&P. I think one thing that's clear, we wonder, what is it that does well after some of this trade turmoil is over? Clearly, the U.S. has an intention to supply liquefied natural gas to countries around the world, and both of these companies, Expand and ARC in Canada, will benefit from the lift in LNG. And then the pipeline companies, TRAP, trading very well close to the highs, and Enbridge also very resilient. So infrastructure in general has done well because, again, infrastructure not subject to tariffs. We've been looking at airport companies around the world and toll roads. These are companies that have pretty resilient cash flows and not terribly economically sensitive. We are seeing a pickup in Chinese demand for Canadian oil as they have backed off buying US oil. And so the new pipeline to the west certainly helpful, but I think need more pipelines to get our Canadian oil out to the rest of the world. We watch it for that. On the golds, as I mentioned, down a snip today, but that was a big breakout going back to 2020. They look very, very strong, and I would expect any kind of consolidation would probably be viable. We own Agnico, we own Wheaton Precious Metals. They've been tremendous and very good hedges in the portfolio. Alamos also has been very good, Franco-Nevada. So this group continues to behave well. And on the industrials, it's still a mixed bag. We're trading above the long-term moving averages. Brent has thrown some improvement. The aerospace companies in general, this is the aerospace ETF XAR, made up of companies like, Raytheon and Lockheed Martin and so on. Our go-to company all year long has been Howmet Aerospace, that makes fan blades for jet engines. And it's done better than 95% of companies in the S&P over the course of the year. So our list is certainly thinner. The waste companies have held in really, really well, both Republic Waste in the US, Waste Connections, GFL. Again, not a lot of tariffs on waste. But on the other side, transport's been weak, and so we've avoided these. So it's a mixed market. In communications, Netflix has been a champ. We're basically closed today, if not at a new high, within a whisper, and better than 97% of companies in the S&P. We've also looked at Spotify. We've looked at Take-Two and the video games, all of them subscription-based businesses. But tech continues to be a problem. And I just highlight this because, the relative underperformance began in June, July, before we had any idea who was going to be elected. Part of it had to do with long-term rates being high and sticky. And if you're buying an earnings stream that goes way off into the future and have to discount it back to the current value, you have to use the incumbent interest rate. And a high interest rate means you can, have to pay a lower multiple of earnings. So relative strength has been weakening pretty steadily. We're sort of not there. It's a big part of the market. It was 30% of the market. At the worst point, the XLK ETF was off 25%. We're a little bit higher than that right now, but relative strength has stayed weak and it's below all the moving averages. One thing I was going to mention is on the S&P and all of these charts, these ones that are in sell-offs, you'll see that they tend to stay below this 21-day moving average. So for the S&P, for instance, one of the things we're watching for is if it can get above the 21-day moving average and not just get above, but stay above for 3 or 4 days, signaling some kind of change. And we use the same idea for some of these sectors that are really weak. We want to see a pickup in relative strength. We want to see improvement in breadth, and we want to see them get above some of the moving averages. And this really is not a picture that's getting any better. Magnificent Seven, owned by everybody. I mean, everybody, especially global investors, continue to be under pressure. And semiconductors, really relative strength continues to be weak. And this is an indication sometimes of economic expectations because semiconductors turn over very quickly, and orders come in quickly or they slow down quickly. So we're watching signs. So it'll be interesting to see the commentaries we get coming through this earnings period. So it is haves and have-nots. Consumer discretionary continues to be quite weak. Companies like Amazon probably have a lot of question marks as to their supply chain and what will happen with the change in tariffs. And when we look at the sector work, on the 11th of April, really, sectors had all moved to the far left-hand side, meaning only a small number of stocks within each sector were performing well. Most of them were in small letters. Market's been doing some sorting. As we sit today, the average sector has 25% of stocks in uptrends. We've seen a little bit of movement to the right, more sectors that are in large letters, which means breadth is expanding. But similar to the way it's been for quite some time, the strongest groups, pipelines, that's gas utilities, precious metals, insurance, banks, electric utilities, aerospace. The same groups are the strongest groups. And that's interesting because sort of this is where we are focused. When we look at our weightings, materials is at 16%, and that reflects the gold producers that we own and the fact that a couple of weeks ago we added the physical gold ETF, PHYS, which is an ETF that owns physical gold. Gold has been a lot less volatile than a treasury bond, and it's been a much better hedge in the portfolios. So that's been a great addition. Our cash weight, as you can see, came down a little over the last month, partly because we moved some more money into corporate bonds, short-term corporate bonds, and partly because we did buy a couple of global financial companies. Government bonds, again, short-term, that's up quite a lot. These are just a place to put the money to keep it safe and flexible. Financials, up about 4% over the last week. That was the add of some international financials. And energy is around 10%, which is a big overweight. But as I mentioned, it's half pipelines and half natural gas producers. At the other end of the spectrum, real estate is really not there. It gets hurt by higher rates. Technology is about 1%. Healthcare is about 1%. Consumer discretionary is about 1%. And, we're talking about companies like Loblaws and Dollarama here. We're not talking about big expensive items, and consumer staples at about 2%. So it's a thin portfolio. We have a lot of cash. We'll look forward to being able to put it to work at some point because, frankly, over time, the purchasing power of cash goes down. And that's why we tried to hedge the portfolios for inflation. But it's paying off for us. With the S&P down 15, the NASDAQ down close to 20, our average account is probably down 3%. So I think we're in pretty good shape. Things we're watching, credit spreads, the excess yield that an investor is demanding to buy corporate obligation versus the government has started to widen a little bit. That's for investment grade and high yield. It's nothing like what we saw in 2020. So it's not saying that we have a big economic problem. It's certainly nothing like 2015 and nothing like we saw in the financial crisis, but we're watching it. When we look at volatility, we talked last week about wanting to see, after a spike in volatility, for volatility to come back down into this range. And so far it has stayed stubbornly high. Another reason why we're cautious. We know that during more structurally constructive markets, volatility tends to stay in this range, kind of between 19 and 10. And we're sitting at 30. So that's another thing that we're watching. And so while, we haven't come down and broken that 200-week moving average, we're letting the evidence unfold. I think that there's no race. It would be rare to see the market turn around and take off. I think everyone's always afraid of that when they've got cash in the portfolios. But this is one of those great opportunities where we get to see the market sort. And the market does a good job of sorting good from bad. And we're building our farm team in the process. Things get worse, we get more defensive, but we're pretty darn defensive now. We do have a history of that. And we'll take the information as it comes. So not an overly rosy picture, but there's lots of things that are working and lots of places that, we can be positioned that are performing remarkably well. And frankly, global stocks are really, really underowned by US investors. They're underowned by local investors. And so we do think that there's lots of room to run there. So one of the things we'll continue to do is increase our global weight. I think that our precious metals weight is something that we'll continue to hold on to. I think that there's years in front of us with corrections that we can take advantage of. We're watching for more improvement in energy, and we're watching for improvement in some of the commodities, and that will come as we get more commentary on the election. So with that, let's just see if we got any questions here. Harry Field asked a question. Sorry, Harry, shouldn't have used your whole name there. You seem to prefer PHYS to GLD. Is there a reason? So GLD and PHYS are both ETFs that their price is derived based on what's happening with the price of gold. PHYS is run by Sprott, and they, in their prospectus, have an agreement to hold physical gold to back the ETF. GLD is a promise to pay based on the return of gold. So if you think that gold plays an important role, then you probably want to use the PHYS. Okay. Lawrence asks, I bought a small position in IBIT. What percent of the portfolio would hold IBIT? Okay. So IBIT is the ETF that is an ETF for Bitcoin. It's about the lowest cost ETF. And so it's one that lots of people have looked at. We own about a 6.5% weight in our global macro portfolio. So our global macro portfolio is a pool that can be in any asset class, long or short. And so it can be in stocks, and the stocks what we own there from an equity perspective right now is largely global stocks. And we talked about some of the charts today, the ETFs that we own. We also own a significant position in both precious metals producers and ETFs. And then we do own some Bitcoin, IBIT. And I think it's interesting that Bitcoin started to decouple from tech stocks in the last month. For a long time, when tech was weak, so was Bitcoin. And I think part of that has to do with the fact that so many investors who own Bitcoin also are tech investors. So when they're losing confidence or needed to raise money because maybe they were using margin, they were selling Bitcoin along with tech stocks. Since you had the big downdraft in tech and things stabilized a little, Bitcoin has started to act more like a currency hedge, like gold, than like a tech stock. So I think that's interesting. It may be that Bitcoin is ready to have another move higher. It is outperforming the equally weighted S&P. Rob is asking, how does the price of gold and the price of gold stocks typically behave during a recession? Thanks. Well, gold has had a tendency to hang in well against a recession. It's also held in well in the event of an inflationary period. And certainly, I think safe to say tariffs are going to cause some inflation in the system. It's also tended to do well when the US dollar was weak. People looking for a different safe haven to put their money. So it can do well in a bunch of different kinds of environments. And Jerry is asking what the current volume on the S&P indicates. So one of the things that I would say is that in general, and I'll just see if I can share my screen here. Okay, so if we pull up Spider, you can see that, just look at a daily chart. You can see that we had quite a giant spike in volume at the lows. So that often happens, that's panic. And you did have a bounce. So as I mentioned, we're trading below the 21-day moving average. I want to see it get above the 21-day. We want to see a big volume and big breadth day, like this was 34-1 up stocks versus down stocks. We have not seen a follow through, so that should happen generally within a week of the first one. So this first big breadth day is voided. Now we need to see another big breadth day on big volume, and you can see we haven't seen one yet. So, a lot of people have been conditioned to buy dips, and they certainly, bought the dip in the NASDAQ 100, big volume days. But we haven't seen follow through. So my only concern is we probably have a little bit more work to do. It's very possible that, we've now broken the trend on the NASDAQ 100 that goes back to the beginning of this bull market in October of 22. We've been unable to get back above any of the moving averages. It's getting to be more of a question as to whether, in fact, this is something bigger than just a cyclical pullback. So we'll see. The upshot is, I think that there are better places for your money that are less crowded. There's a lot of people who bought the NASDAQ over the last 3 months thinking they were buying the dip, who are now underwater and just want their money back. So I've always said when something has strong relative strength, and NASDAQ doesn't, and a strong trend, there's a lot of happy shareholders. And as we sit right now, there's a lot of unhappy shareholders who are underwater, who just want their money back. So I think that the market's going to have to fight through a lot of that. And I would prefer to be in the sectors that are less owned, that are performing better, where shareholders in general are happy, and where new money has been, represented well. For instance, some of these insurance stocks and some of these global financials, very quick to go back to make new highs. And this is after, years of underperformance. So probably some good opportunity there. Okay, I think that's all the questions we got. Looks like I didn't get my video on today. I think I got a problem with my camera. Sorry about that. I hope everybody has a great week. Reach out if you got any questions that we haven't answered. We'd love to talk to you. And if we're not clear or we're missing something, please let me know. We'll try and include it next week. Everybody have a great week.